Welcome to the deep dive. Today we are tackling what you could call the silent killer of investment returns, taxation.
Right.
You can be a genius investor, pick all the market-beating funds, but if you treat the tax man as, an afterthought.
You are just giving away wealth, significant long-term wealth.
Exactly, wasted compounding power. So we've gone through a stack of professional investment materials, and our mission today is pretty simple. We're going to extract the key strategic shortcuts. We're focusing on the relationship between your returns, the allowances that protect them, and, crucially, the wrapper you hold them in.
And that's it. That is perhaps the single biggest area of confusion for new and honestly experienced investors, too.
Really? Even experienced ones?
Oh, absolutely. If you're looking for the most efficient knowledge shortcut, it starts right there. You have to differentiate between an investment in a taxable general account.
A GIA.
A GIA, exactly. And one held in a tax-efficient wrapper, like an ISA or a pension. We see clients just ignore the wrapper, and that oversight can cost decades of efficient growth.
Okay, let's unpack this. Because before we even get to the protective shields, the wrappers, we need to establish the battlefield. The three fundamental ways your investments can generate taxable returns.
Right. And we basically categorize them into three buckets: interest, dividends, and capital gains. Each one is handled differently by the tax system, and each one comes with its own set of rules and allowances.
Let's start with the simplest one then. Interest income. That's from things like cash, bonds, that sort of thing.
Exactly. It's taxed as standard savings income. The protection you get here is the personal savings allowance, or the PSA.
Okay.
And this allowance shelters a certain amount of that interest from tax each year. It's great news for basic and higher rate taxpayers.
But, and this is a big but, here's where that strategic insight comes in for high earners. If you're an additional rate taxpayer in that highest income bracket, you get zero personal savings allowance.
That's right. Nothing. For those investors, the very first pound of interest they earn outside of a wrapper is taxable at their top rate. It completely changes the game. It forces you to prioritize wrappers for any fixed income assets. That whole allowance planning layer just disappears.
A really clear distinction right from the start. Okay, so moving on to the second form of return, dividend income. This is for shares, equity funds.
Correct. Now, dividends are taxed according to your income tax band, but, and this is key, they are not taxed at the same headline rates as your salary or interest. They have their own tax structure.
And their own allowance.
And their own separate tax-free allowance, which, it's worth noting, has been cut pretty significantly in recent years.
So that's a headwind for anyone with a big equity portfolio outside of a wrapper.
A huge one. You use up that smaller allowance very, very quickly.
Okay, and that brings us to the third one, capital gains, the big one.
The big one. This is usually the largest component of long-term growth, and it's where the most proactive planning can happen.
And the tax is triggered only when you sell for a profit, right?
Right. Yes, when you sell. That profit is first sheltered by the annual capital gains allowance. Anything you realize above that is subject to capital gains tax. Again, the rate you pay depends on your income tax band. Basic rate taxpayers pay a lower CGT rate.
What's fascinating here is it's not just a case of, well, I made a profit, now I pay the tax. There are so many practical tools available to manage it.
Absolutely. The core tool is the ability to offset losses against gains. This is a crucial planning lever.
So how does that work in practice?
Let's say you made a 20,000 pound profit selling a tech fund, but last year you sold something else and made a 5,000 pound loss. You can use that registered loss to reduce your taxable gain. So you're only taxed on 15,000 pounds, not the full 20.
That's powerful.
And advisors use other strategies like gain harvesting. This is all about timing. You time the sale of assets over several tax years. That way you use your full capital gains allowance each year. Instead of realizing one massive gain in a single year and facing a huge bill, you're spreading the gain to spread the tax.
It really sounds like active management of your tax bill, not just passive reporting at the end of the year.
That's exactly what it is.
So we've set up the battlefield. We have the three types of income, their allowances. But as you said at the start, the real power comes from where you put the investment. Let's talk about those ultimate tax shields, the game-changing power of wrappers.
Right. When you put an investment into a tax wrapper, you are fundamentally changing the rules of the game. Let's start with IS individual savings accounts. They are the definition of simplicity and power.
The ultimate shield.
Yes. An IS shields all forms of return, interest, dividends, and capital gains. All of it is protected from tax, forever.
And the withdrawals are tax-free too.
Completely tax-free.
It sounds so basic, but I think people consistently underestimate how powerful that is, especially for medium-term goals, because the money is accessible.
It is. Maximizing your annual ISA allowance is almost always the first tactical priority for most people,
Okay, so then we move to pensions. You called them the long-term accelerator.
because they offer a different flavor of tax advantage. The big benefit is front-loaded. Your contributions get immediate tax relief. The government is effectively topping up your savings from day one.
And inside the pension, the growth is tax-free, just like an ISA.
Exactly. The tax event is deferred. It's pushed down the road until you take the money out in retirement.
And even then, withdrawals are taxed as income, but you usually get that 25% lump sum completely tax-free.
Which creates this phenomenal engine for compounding, especially for younger investors. When you combine the immediate tax relief with decades of tax-free growth, pension maximization is strategically unbeatable for long-term saving.
But what about the access? Isn't locking money away until you're, 55, 57? Isn't that too big a hurdle? Shouldn't you always prioritize the flexible ISA first?
That's a fantastic point, and it's why strategic tax planning is never about picking just one wrapper. It's about how they work together. Which brings us back to the general investment account, the GIA, the default unwrapped account.
So the GIA is where all those rules we talked about earlier, the PSA, the dividend allowance, CGT, that's where they all apply directly.
Precisely. No special protection. You're relying solely on those annual allowances to mitigate the damage. Advisors use GIAs, but usually only after the tax-free options are maxed out.
Here's where it gets really interesting. This idea of layering the wrappers. It's not just about picking one, it's the order of operation.
Layering, yes. This is how you maximize tax efficiency over your entire life. There's a general priority order.
Okay, walk us through it.
First, you maximize the ISA. Why? Because it's accessible, and the growth is completely tax-free. It gives you flexibility and a total shield.
Makes sense.
Second, you maximize your pension contribution limit. Why? Because that immediate tax relief is like a guaranteed bonus on your contribution.
Yeah.
You accept the trade-off on access for that unparalleled long-term growth potential.
And only then.
Only once those two allowances are full do you then move to the unwrapped GIA. And within that GIA, you actively manage things, using up those remaining allowances for savings, dividends, and capital gains. This approach ensures you're controlling tax exposure all the way through your portfolio's life.
That layering concept seems straightforward enough for standard funds or stocks, but things can get complex really quickly, can't they? Which brings us to part 3, complexity and hidden liabilities.
Let's start with a really common pitfall, the fund structure itself. You'll see funds advertised with accumulation units versus income units. Income units are pretty clear. They pay out cash, you get income, it's potentially taxable.
Right. But with accumulation units, the income is just reinvested back into the fund, so the price goes up. A lot of people assume, well, I didn't see any cash, so there's no tax to pay.
And that is the trap. The key detail is that the income is declared by the fund, even if it's immediately reinvested.
So it's like phantom income.
Exactly. That phantom income might still be taxable to you, eating into your personal savings or dividend allowance, even though you never physically saw the cash. It's a classic hidden liability.
Okay, that's a big one to watch out for. What about another area of complexity, like investment bonds?
Investment bonds. They are a completely different beast to ISCs and pensions. They offer tax-deferred growth, not tax-free growth.
Tax-deferred. So the tax bill is building up, but you don't have to pay it yet.
Precisely. Think of it like a financial pressure cooker. All the interest, dividends, gains, they're all accumulating inside the bond without an immediate tax charge.
The clock isn't running yet.
The clock isn't running. The tax liability is deferred until you withdraw the money. That's called a chargeable event. And when that happens, the gain is taxed at your marginal rate, which can create a huge income spike in that 1 year.
Which is why you need that special feature, top slicing relief.
Absolutely essential. Without top slicing relief, a large withdrawal that represents, say, 10 years of growth could temporarily push you into the highest tax bracket for that year. Top slicing lets you spread that gain over the number of years the bond was held, just for the calculation, which can dramatically reduce the tax bill. It's a safety valve.
That makes sense. We've talked about a lot of active tools, but what about hidden dangers? Let's talk about portfolio rebalancing risk.
This is a critical warning for anyone with a large GIA. Your advisor or your platform might suggest adjusting your allocation. Selling a global equity fund that's done really well to buy a bond fund.
And if that equity fund has gone up in value, even though you're just reinvesting the money straight away, the act of selling it triggers capital gains tax.
It absolutely does. The transaction is a disposal. The profit is realized, and it's subject to CGT minus your allowance. We see investors get caught out by this all the time. They assume switching funds is tax-free because the money stays invested. It's not.
A powerful lesson in knowing which wrapper you're in.
You have to check the gain-loss position before you make the switch in a GIA.
Okay, let's zoom out one last time and connect all this to estate planning.
This is where the choice of wrapper can have, well, an irreversible impact. Generally, assets in a GIA or an ISA fall inside your taxable estate. They can be subject to inheritance tax.
But pensions?
Pensions usually sit outside the taxable estate. They can often be passed on tax-free to beneficiaries, depending on a few factors.
And that distinction is a massive strategic component in someone's legacy.
It is. It's the final layer that shows why investment tax planning is never just about the numbers on a screen. It's about aligning every decision with your time horizon, your behavior, and your long-term goals.
So we've covered a lot. The 3 types of income, the major allowances, the powerful shields of ISAs and pensions, and then the complexities of things like accumulation units and investment bonds.
And the central theme, I think, remains clear. Efficient tax management comes from using every allowance you have, choosing the right wrappers for your goals, and proactively managing those taxable events. It's not a separate issue. It has to be integrated into your core strategy.
So what does this all mean? It means understanding the why behind tax planning is the foundation for financial resilience. It ensures that when your investments grow, you get to keep the part that you could have protected.
Exactly. And as you think about structuring your own investments, remember that dichotomy we talked about. While ISAs and pensions offer phenomenal tax-free growth, the structure of an investment bond with this tax-deferred growth raises an important strategic question. In what specific scenario might deferring your tax liability, rather than removing it entirely, actually become a strategic advantage? Maybe if you expect your income to be much, much lower in the future, like in retirement, making that future tax bill significantly smaller than it would be today. That's something to mull over.